Okay, so welcome. Good evening, everybody. And at the onset, Eid Mubarak to all our participants, and thank you for dialing in on a public holiday. And I think we will do justice to your time today. And the topic is very interesting today: advisor longevity, key for key for quality advice. And we will dwell on this topic. We'll discuss more, and we have a very special guest that today with us, Mr. Atul Singh. I'll just give a glimpse of Mr. Atul Singh, and Mr. Atul has has a long illustrious career with wealth management across geographies from US to India, and he has overseen transition of organizations. He has seen billions of dollars, managed billions of dollars for clients, and has and has ensured that all his army of RMs or advisors stick with him through thick and thin. And that's just one of his qualities. He dons a lot of hats. So a little bit of background: Mr. Atul is an MBA from IIM Bangalore, and post which I think he started with Merrill Lynch, and then moved on to what was then Julius Baer, and then now Validus. It's been an interesting journey, and my other two hosts, Mr. Vikaas and Sachin, will talk about that more. Vikaas is, of course, now a familiar face with us, and Vikaas is one of the most senior and respected veterans in the industry. He has an experience of close to 25 years now, and has chaired many important roles, and has developed organizations, has worked with the regulators, with the industry bodies, and is very insightful, and he drives the discussion on the talks that we have in a very fruitful manner. And I think this time is going to be no different. Then on, we have Sachin. Sachin is, of course, the fund manager with Emkay Investment Managers, and he is credited to develop his own framework for identifying corporate governance or good corporate governance in Indian companies. And he has been a fund manager for close to almost 15 years now. He's worked with marquee names like Motilal and MK, and he's worked very closely with Ramdev ji, one of the most senior fund managers in India. And his insights today will probably help us know more about our topic. Before I come to conclusion of the introduction sessions, there's another entity that we have to introduce is FinLearn, who are going to sponsor our best question award for the day. And like you all know, this award is given to one question which is asked from the audience and is answered by our guest, that is Mr. Atul today. And FinLearn is an online academy that offers various kinds of courses and various kinds of knowledge for people aspiring to be stock market participants. Courses range from technical analysis to fundamental analysis, momentum trading to long-term investing, and I think it's a good prize to win on the show today. So over to you, Vikaas. That's from me, and I'm excited and intrigued.
Thank you so much, and thank you so much for the PMS AIF World platform for helping us host this discussion. I think over the last few sessions that we've had, it's been very invigorating, very enriching for me, both as an individual and as a person. And I'm particularly excited, for today's session. I have known Atul over the years, and while you've given his professional sort of, profile, let me just give you a few personal insights about Atul, which make him the amazing person that he is. For one, Atul is a cricket fan par none. You might argue that you can say this about every second Indian, but please tell me, how do you know anybody who can recall an innings of a particular batsman from a particular match and narrate it to you with his insight as if it happened yesterday? I dare say you would probably find not too many people like that. The other thing about Atul is his passion. Other passion is wine. His team believes that only a sommelier, a wine expert, would know more about wine than he would. He has traveled across the world and actually stayed at vineyards, literally cultivating his passion for wine. And I was talking to his colleagues and industry friends and all of that, I think 2 or 3 things which came across. One is that he's not just a perfectionist, but he also has this unique ability to be bifocal. He can look at a particular situation both from a 50,000 feet level as well as from the ground level. Ergo, he usually has a solution for most problems. Industry observers also believe, I think you just alluded to that, Sankalpo, that he's one of those few people whose knowledge about the wealth management business is quite holistic, having handled businesses across the US and Asia. Welcome, Atul, to the show. So let me just dive straight in with some questions. My first question to you is, you have the unique distinction of managing
just 1 second. I'm so sorry to cut you, but this is something interesting that I have to share. Like usually I ran a poll. It says I have had the same financial advisor for less than 1 year, 1 year to 3 year, 3 year to 5 year, and 5 year plus. Okay, so only 25% of the people said that they have had the same advisor for 5 year or more. And sorry I cut you like this, but I thought this would be interesting as we begin this topic today.
Very
And
interesting.
this is just a trivia from my side. Over to you, Vikaas.
So, in fact, I just changed the order of my question. This question was going to come in any case. We actually ran a Twitter poll recently, and 61% of the people felt that the right advisor is more important than the right advice. Quite contrary to what your poll is just saying, Sankalpo. So, Atul, I'd like you to just take us through the distinction the way you see it.
Sure. Thanks, Vikaas, and thanks for a very glowing introduction. I don't know whether I would sort of rank as high as you ranked me in cricket and wine, but those are definitely two of my passions. Coming to the question about right advisor versus right advice. See, from my perspective, there isn't anything like a right advice which is universal, right? Very rarely you will have something that works for everybody. And we always say that, look, understanding the client, understanding the context of the client, and based on that, bring advice.
Just a second. Vikaas and Sachin, can you guys mute yourself? That's the echo that is coming. Sorry, please carry on.
Yeah, so as I was saying, that there is nothing called right advice, because there is no universal right advice. It always heavily dependent on the context of the client, the aptitude of the client, the risk profile, and I don't mean the traditional way a risk profile is measured, conservative, moderate, aggressive. I mean, that actually tells us very little about how the client will behave going through market cycles, etc. What their likings, dislikings, aspirations, attitude towards money is. So knowing all that is critical for constructing the right advice for the client, which actually only the right advisor can do, right? And by right advisor, and that's where sort of our topic about longevity is so important, because unless you really know your client, and again, not KYC in a compliance term, but truly knowing your client, unless you do that, it's very difficult to really produce the right advice consistently for a client. So that's how I would differentiate the right advisor versus right advice. Right advice could be manufactured in the back offices of investment management firm, but the right advisor sort of takes that and caters that advice to the specific context of the client.
Very interesting. In fact, when you talk about advisors, I think I'd like to tell our viewers that you have the unique distinction of managing transition of shareholders across two different organizations. And yet, by and large, your team of advisors have managed to stick to the firms you have handled through this difficult phase. The shareholders have transferred, or other, the transitions of shareholders, but there's not been too much of a transition in terms of your advisors, your teams of advisors. Tell us how you managed the same.
So, Vikaas, when you say transition, by definition, it means a period of uncertainty. It means a period of turbulence. And managing through that period requires doing things in a certain manner. Though, I would say probably, I don't know any other way, and it's just you do it that way anyway, but you just have to sort of underline few things. Couple of things that have worked for me is, because you are in a turbulent situation, you don't have all the answers. So you can't be holier than thou and try to sort of create that image that, look, here is the vision and I really want to, get there. Yes, you have a goalpost, but you really know that the path there will be through ups and downs. So the only tool you have is to be completely honest and sincere with your team, right? To really say that, hey, look, here's the path, and these are some of the basic principles that you should sort of stick to, right? Challenges will be there, but one of the basic principles in our businesses, right? I mean, whether you're going through transition or good period or bad period, you got to stick to servicing your clients as well as you can, right? Any transition, if you did that well, if you stuck to your clients, if you continued servicing them, you are not too busy moving paper for serving the client, then these transitions really don't matter, right? If you make an RM successful and an advisor successful in helping their clients, servicing their clients, they are not going anywhere, right? Because that's what they want to do as well. So I feel that a lot of, when you think about uncertain periods, when you think about changing things, people lost focus, or organizations lost focus from the most critical sort of element, that is clients. So if you retain the focus on clients, I think, retaining people is just a byproduct of that, right? I think the other, so this is sort of the softer aspect. The other hard aspect that I feel is critical is that, again, through these uncertain periods, much more, but also otherwise, you go to, as a leader, you got to solve the hard problems together with the team, right? I mean, you can't really, in our business, it's a talent business, right? And you can't, sort of just be, again, in your ivory tower and try to sort of force people and what you call like a program manager, you can't really just ask questions that why is it not done? I mean, you got to, if it's a hard problem, you got to really get in and solve that hard problem. You won't be able to every problem, but you got to be there, right? And leave the easier problems to be solved. So it's not like every problem you have to get in, but choose the hard problems so that that you are seen as a leader who's standing along with everybody solving these problems. Because look, challenges will come, right? I mean, we talk about transition, and I say this again, that transitions by definition are challenging periods. But in a regular, I mean, tell me a serene period where there are no challenges for any business, right? I mean, if the markets are going up rapidly, that's a challenge in our business as well, because clients are worried about too much froth or valuation. The resource cost becomes very high. If the markets are going down, it's a different challenge. So challenges are challenges. These are some of the principles that you have to stick to. And at least in my experience, some of those principles have worked well.
I hear honesty, I hear transparency. While you mentioned a lot of this thing, but this is what clearly I hear. Wonderful. Sachin, do you have any questions?
Yes. Thanks, Vikaas. And hi, Atul. Welcome to the show. Really a pleasure to have you. And I've heard you. And I think it's very important what you're saying. A lot of things I have also played by those principles all my career. And I can fully relate to it. What I wanted to understand is, when it comes to, say, financial advisors, right? We all understand that they have an influence in the financial decisions of your HNI clients or investors in general, right? And over a period of time, these decisions will have certain implications. I mean, how those decisions have played out over a period of time, and obviously the investor does witness this, does observe that. So it's been almost probably, at least I would say, a decade and a half since the wealth management industry in India has had a fairly decent traction, I would say. So in this 15-20 years, or at least in the last decade, do you think that the advisors have found their place under the sun, in the sense that are they earning the respect from their investors or their clients? Yes, that this advisor does make value addition to me, and it does make a lot of sense, listening to him. Have they earned that place under the sun from the investor's perspective?
Yeah, thanks, Sachin, for that question. And see, in India, I think while we have come a long way, but I think a long way is still to be traveled as far as gaining respect is concerned. There is, and that goes along with the transition of the industry per se, because, the advisors are the flag bearers of the industry. They can't really work outside the industry. And the phase that the industry has been probably is still in, but transforming, is still the phase of product pushing, right? So the product provisioning or product sales is the primary function of the advisors so far. And that doesn't lend itself automatically to solving complex financial problems for the client or act as an advisor. Like I said, that, in my first answer, that you need to see the context of the client, tailor your advice as per that. And every time, every product is not true or correct for every client. But in India, because of the phase of the life cycle of the industry that we're in, we're still in a sort of heavy product provisioning type attitude, and that sort of leaves a little bit on the table to be desired as far as the respect is concerned, right? In fact, I actually almost cringe when I hear this statement repeatedly, that wealth management is a commoditized industry, right? And a lot of people, again, based on my personal experience, I was a good student, gold medal in engineering, IIM Bangalore, top ranker, first job in New York City on Wall Street, etc. And I come back and I work in a wealth management business, and I start a wealth management business as an entrepreneur, right? So a lot of my friends ask me that, look, what are you doing in wealth management business? I mean, what's so great about wealth management business? And, are you doing justice to your own talent? And that's where sort of this disconnect is, right? Because people think it's a highly commoditized business. But I think that it is absolutely a business where a lot of very fine skills kind of come together, right? Because you can be as deep as, in the investments world, trying to really understand different asset classes, different portfolio construction, India, global. I mean, there's just so much to know, both at the macro and the micro level, right? As an advisor. Plus, it is about people, because, you sit in front of the client and you're able to build enough trust with the client for them to give you their money, right? That cannot be a commoditized job, right? So, as a fund manager, you have the first part, but you're also not out there sort of trying to build that trust with the client, right? So just think about it. I can aspire to be you in terms of your intellect level and understanding of the markets, as well as I can try to be, the best sort of extroverted guy out there trying to build relationship with the clients, right? And many, many, many other aspects that this job, this industry involves, right? I mean, the succession planning, the tax planning, just the whole financial life of the client. So I believe that there is a lot of intellect that can be put in this business. We are very early in that phase of putting that intellect. So unfortunately, my answer to your question will be no. We are quite far from gaining that respect from clients in terms of what we do in this industry and what advisors do. And I would have to sort of attribute it to the age of product pushing that we have been. But I hope that that we actually transform from that image to come to an image where we get our due respect, and client does not automatically assume that it's actually a commoditized industry and it's easy.
Right. Atul, I sincerely appreciate a very, very frank and a very honest answer. And frankly, I can completely relate to it. But I would just like to add that, how much ever we think, but my experience has been that investors also do, I mean, a good part of the investors over a period of time do realize the authenticity of the advisor. And I have experienced that last 20 years, that investors who have been with me, at least 50-60% of them, walk with me. And that comes to my second curiosity. And I'm going to be a bit of a devil's advocate here, Atul. We just spoke about the longevity of the, advisor, right? But look at it this way, that, as an investor, I'm associated with your firm, right? And, as a firm, you might be giving certain asset allocation calls, right? That today you go underweight in a particular asset class, you go overweight in a particular asset class. That's one part. Second, as a firm, you might be getting certain specialized products for me, Okay, a niched out products which are exclusively designed with your firm. You might have tied up with some manufacturer or certain investment managers, and you would have created those niche products, right? And then those products are brought to me by your advisor. Now, after a few years, the advisor decides to move on to another wealth management firm. How do I, as an investor, decide whether I like the advisor, I like everything he's done, but I'm not sure how much role did he play in getting those products or getting that asset allocation call. He had the right interest for me. I'm not doubting that part, but there are two parts, right? The integrity and the capability. Now, how do I decide the capability was the firm's strength or was it the advisor? And that's where the longevity of the advisor is sometimes. As an investor, how do I evaluate that? Should I stick to the advisor or should I stick to the firm? And I'm just being a devil's advocate. I'm just trying to get the best out of you.
Yeah. No. See, so the capability comes into sets, right? So the first part of capability of constructing a financial product that has better risk return, it's on efficient frontier, etc. That, of course, is outsourced to, let's say, the institution. But of course, the enough sort of financial understanding of that product, the risks that that product carries, and being able to fully articulate to clients, and also then mesh it with their context, right? Whether it works or not. That's that level of finance. And by the way, that doesn't come without a base minimum financial market understanding, right? Because you got to understand the risks. Right. Every product has risks, right? And in fact, that's where the advisors have to do a better job of institutions have to do a better job of articulating them, and RMs have to do a better job of understanding them. But so that's the capability that I would look for, right? And it's not that difficult. Believe me, Sachin, it's not that difficult from an investor's perspective to really understand that somebody is only peddling a product that is coming from his product team, or he really understands this product. And I don't expect him to create this product, but I want him to understand. I expect him to understand this product and also articulate to me why it actually is relevant for me in my context, right? And that's not that difficult to really judge. And then the second part is also very, very, very critical, is the intent, right? Now, the intent of whether the advisor is on my side or is driven by, KRAs are important and revenue is important, but it also very, very clearly shows in first view interactions that, what's your intent. I mean, it's not, it won't be clear just by talking to me for the first time, because, obviously it's a very experiential thing. Everybody says that I am the good guy, but I think very quickly you'll be able to realize the intent and also the capability, which again, like I said, I'm limiting that capability to really understanding the product that you're bringing. There is no excuse for not understanding it. I'm not really holding you responsible for creating it, but I hold you responsible for understanding and fitting it in my context. So that is actually not that difficult for investors to understand and decipher. And if they are able to really get confidence in these two aspects, I think they should stick to that advisor. Now, this question, again, I'm just taking a little bit more time because I want to talk about this particular question related to longevity, but also, a lot of RMs or advisors talk about, does longevity mean staying at one firm for 20 years or 30 years? I mean, what does it mean, right? I mean, should I not change jobs? And again, in my career in the US or Singapore and in India, I've hired many advisors. We've built credibility with lots of advisors, and a lot of these discussions are focused on how should they think about their career, right? In order to inculcate this trust with clients, not get stuck at one place, but yet have longevity, etc. Right? So there, if I really sort of elaborate that. And again, I'm coming back from the perspective that if your movements, change of jobs, etc., are in that context, then it is okay. Versus not being in that context, then it's not okay, right? So I always believe that globally, if advisors have three lives. they have 3 lives in their career. A good, successful, fully built advisors have 3 lives and 3 growth curves, if you will, right? They are not linear, but they are 3 sort of different growth curves that are stacked on top of each other. Advisors should not think about this firm versus that firm, right? I mean, if they change jobs within one growth curve after 2 years, 3 years, believe me, they can, again, take it from me, having spent my life in this business, they can never become a substantial advisor, right? It's just out of question, right? I mean, I look at somebody who has changed jobs every 2 years, done. I mean, there's just no way you can. In fact, many good advisors actually run the risk of overstaying at a firm, right? So, what are these 3 sort of growth curves, right? So, I believe that if you really systematically think about their careers, the first is, let's say you join a bank, right? So, as an advisor, you join a bank. You really have no capability about delivering either financial advice or acquiring a client. So, you join a bank. The bank, so HSBC, Citi, and we see a lot of good advisors coming from Citi, HSBC, old HSBC, Standard Chartered, now HDFC Bank, etc. A lot of advisors, and again, this is not India, globally, this is the trend, right? So the first life of an advisor, serious advisor, right, is spent in a bank, because there they are not acquiring clients, but they cut their teeth on servicing a client well, right? I'm talking about good advisors, right?
Sure.
So they cut their teeth, they use that opportunity to really deliver good quality advice, understand the financial markets, understand how to build larger portfolios, not build, but manage larger portfolios, etc. So let's say out of 3, that's your first 8 years. In your 25-year career, that's your first 8 years. You can't overstay in that growth curve, because at some point, now that you have sort of earned enough stripes under your belt, you want to move to the next growth curve, because the real sort of value comes in when you, like I said, you have the ability now to sit down in front of a client and talk so much sense that the client is willing to give you money, not because you work for the bank and the bank already has the money, but you work for a firm that is not giving you a loan, that's not giving you checking account or savings account, that's not your transactional bank, but you're cutting a 20 crore check to that firm, right? It requires a very different skill set. But having acquired the first skill set, which is learning the servicing the client, larger client very well, now you jump onto the second curve where you're not only doing the first part, but you're also now going out and acquiring clients, right? And then you obviously build a really and irrespective of the firm, right? I mean, there is bank and then there is these non-banks, right? You build, now you are a real private client advisor in that phase. So let's say you spend another 8 years there, right? Now the last stage, and in India, that stage has not come for most advisors, because like you said, the first, the industry is 15 years old. So, most people are either in their first stage or the second stage. But the third stage of these advisors is when now in the second stage, they still need a brand name. They still need an institution, right? Because client will not trust them directly. Yes, they are a good guy. They tick the 2 boxes that look, they are very, very good intent, solid intent, and very solid understanding of translating the stuff that is given to them in the context of the client. But they're not, they can't work without an institution, right? But believe me, after 15, 16, 20 years of properly doing this business, you actually are ready. You have been around the block for a few times and you're ready. You actually don't need any institution. Now your book of business is so strong and you know your clients so well that you can go, world over, it's called independent, right? Independent advisors, the external asset managers, whatever you call it. You don't need, you can really go and put a shingle or put a board of, Sachin and associate on your shop. And you will have the same clients do business with you, because they now don't need an institution to really drive that company. So that's, and all of these, because, the monetization for the advisor also, right? As you would imagine that in the first phase, banks, the compensation is limited, because they say, hey, we give you the client, right? Why should we pay you that much? But then once you're ready for the next one, you go there and you extract a lot more economics, because now you're not just servicing, but you're also acquiring. And then the third, obviously, you have a lot more economics coming to you because, it's your business, right? And you really have no support of the business. So in that context, if people are sort of 8 years later, if my advisor comes to me and saying like, hey, I'm making this jump because I need to get not only me, but you to a different growth curve. I'm not doing it for myself. I'm actually doing it for you because I have given you everything that this platform had to offer. And now I want to really upgrade and go to the next one. And 8 years later or 10 years later, if he comes back and tells me again, I would honor that. But every 2 years, if you really, come back and tell me, there is no excuse for that.
Yeah, Atul, that's very, very well articulated. And I think that has put the entire context in place. Now, let me ask you one more thing related to this. As an investor, I know that my financial advisor has a lot of information, a lot of knowledge. How do I convert that into wisdom for me? How do I extract the best out of him? I'm asking now from an investor's perspective. What should I do as an investor to get the best out of my advisor?
No, so it goes back to the same point, right? These are the two sides of the coin. The advisor can serve you better if he knows more about you, right? Goes back to knowing your client.
Okay.
So if right. I as a client, and again, that's the problem in India, right? Because like I said, it's the industry. If my buying behavior as a client is buying products, right? I can't really reach that level, right? I mean, everybody that I talk to, I first of all have this perspective that you've come here to sell me something. Let me keep my guards up and see what you have bought me and evaluate it. And then, if I like it, I buy. Otherwise, it's fine. I mean, I'll talk to the next guy. So till you really keep that buying behavior of buying product, you cannot extract the best out of an advisor, right? So for example, right, let's say, I'm also a financial advisor, right? I also go to a client. If the client has the same sort of screen in front of them, right? And maybe it's a very large client. Now, if they keep that screen, I cannot help them. They will look at me as, okay, let's hear what Atul is saying. And if we like the product, they can extract much better because I have seen global markets. I have seen, 20 clients in different markets in their context, how to plan their wealth. They could extract all that. But if they have that screen in front of them, they wouldn't extract that value. So it is about opening up. So my advice always is that, look, it's a very important decision. You test the advisor exactly on the two frames I said before, right? Intent as well as the capability on the translating that product understanding for me and catering it. I test, but once you pass the test, then I trust, right? Then you trust, and with that trust, then you can extract the best out of the advisor. And again, if the advisor, a lot of clients also ask me that, look, my advisor is now moving from this firm to that firm, and what should I do? And I tell them that, look, if that guy has passed these two tests and has demonstrated it for 5, 6, 7, 8 years, and just look at how long he has stuck to his current firm, and if he has stuck for that long, then it's a privilege. It's absolute privilege for clients to find an advisor like that, right? You go with the advisor. There is absolutely no doubt there, right? Because the platforms, our business is not about products. It's not about products, right? I mean, even in our firm, we say that, look, we are not responsible for product innovation. We can't innovate products, right? I mean, if you do too much of product innovation, you lead your clients into financial crisis. I mean, the whole financial crisis was over product innovation, right? We are not. We are there to innovate the process, right? Our business is about process innovation. And can you really put the better process of understanding the client and provisioning what the client needs? So the platform will be there, right? I mean, this platform or that platform. But if you're privileged enough to have an advisor who you have built these two sort of aspects of intent as well as the capability on that sort of limited scale, and if the advisor has done his time on pushing in a straight line with patience, with intent, with capability, then you go with it. Not easy to get that advice.
Right. So I completely understand what you're saying. And basically, if I can articulate it in one line, probably, if an investor is only looking at returns, okay, then it's very difficult for an advisor to actually help him out. But if the advisor is actually going to help him get the risk-adjusted returns, looking at the profile of the investor in the context, then probably that's where the value addition the advisor can actually get it, right?
Yeah.
That's very, very helpful, Atul. Because you can carry on. I'll come back.
Because Sachin, as you know, the advisors don't control returns, right? Even you don't control returns. Nobody controls returns.
Yes.
So the measurement to judge an advisor on the return is absolute return. I mean, not the like you said. You use the word risk-adjusted returns. Most investors don't understand what that means. It's a jargon, but yes, I think meeting the objectives, having the right process, a lot of those things are far more important.
Sure, interesting. There is this maxim that I have, and I've always believed in that clients invest when they're comfortable, not when they're convinced. And when you peel away the comfort part of it, intent, capability, longevity, experience, I think all of these are essential ingredients in terms of making clients comfortable with the advisor. Coincidentally, my next question, which I was going to ask you, there is Gautam Somayaji, who's actually made a comment in the chat box. I'm just going to read out his comment and then I'm going to ask you the question. His comment is, the biggest problem with wealth management firms, this is for wealth management firms in general, is that they launch prop products so that the client money is stuck with the firm and the RM can't take the client. Okay. Plus, of course, prop products give you a higher commission. And my question basically was, with respect to global standards, you've seen pretty much whatever it is in the world. How would you compare the Indian financial advisory system to what you see in the rest of the world? So I think in a way, both these things are connected.
So Vikaas, there is no doubt that a properly structured open architecture advisory system is superior than any other system that has proprietary manufacturing. Now, but proprietary manufacturing is very tempting for making the economics, right? Now,
absolutely.
And again, if I zoom out from what I'm doing to, let's say, 30 years ago and have a global perspective, I can give you case examples after examples after examples of the firms making that mistake over and over and over again, right? And eventually realizing that mistake, it does not end well, because there will be a tough time, right? There will be a crisis, there will be a financial market crash or downturn or whatever it is, right? It is bound to happen, because we do face market cycles. And you got to answer this question, that why did my objective, unfettered objective, is to bring the best investment idea or best investment capability to the client. Period. There is no other sort of if and but there, right? As an advisor, my job is to bring the best capability, best product, best investment sort of structure out to you. Now, when I hit a crisis and I see people, out of the 20 crores I have, I mean, about 15 crores are invested in your product, right? I mean, whether it is a real estate fund or a private equity fund or a mutual fund or whatever. This is the question that you got to answer, that do you think that on all of these asset classes, this particular firm has the best capability to manage these assets, right? And the answer is very, very difficult, right? It's so when things go well, then it is very tempting, because it obviously makes tremendous economics, but it holds you back in being able to answer this effectively. Now, you see, I worked for Merrill Lynch for a long time, and Merrill Lynch had a very large asset management business at some point, which they sold to BlackRock. Why? Because of the same point, right? That look, beyond the point, you cannot really resist this temptation to sell your own products, because, and it happens slowly, and it kind of, even if you put these markers in place, this sort of creeps on, right? Because even if you say, no, I mean, I'm not going to sell my own product, completely independent, Chinese wall, it's fine, but the lure for economics is so great that you get lured in, right? And I mean, right now, I don't want to talk about sort of specific names, but since this is a public news, you're seeing the example of Credit Suisse. right? Global Credit Suisse. They had Greensill fiasco, right? $10 billion. Now, they manufactured that, but they sold $10 billion to their own clients, Credit Suisse private clients, right?
Yeah.
Okay. Asset management manufactured that. But how come the whole 10 billion got placed with the Credit Suisse private clients? And I'm not saying it. I mean, these are public reports, right?
Yeah, I see. Very
and now the fund is bust.
Correct.
Right? Now the risk has transferred from your asset management. It's not a fund risk anymore. It's your franchise risk.
Yes.
Because how do you answer it? So, this is a double-edged sword. You need to have proper framework. Now, again, I'm not against manufacturing. Manufacturing to fill a gap has to be there, right? So let's say, if, to use your term, risk-adjusted return. If I say that, hey, large cap funds, large cap stocks managed in a very disciplined manner, why should I pay 2.25% to a PMS manager? Maybe, my PMS manager or my team can manage it at 1%, right? Or I don't want to create a product that is very model portfolio driven and every product portfolio looks the same. My job is to manufacture a portfolio as per the client's requirement. So maybe I have this very customized, staggered investing PMS product, which is not a product, but it's a solution, but I'm manufacturing it for the client. Now, this fills a gap, right? It expresses my advice in a very customized manner to the client, and it limits me, right, to that space. But am I going to become the best stock picker in the mid cap space and the small cap space and the alternative space? I doubt it, because it requires very, very different investment, right? So that would be my my perspective, Vikaas, on global versus local. Again, in India, it's an evolution, right? I mean, you will see firms evolve. There will be market shocks up and down. You will see markets evolve, and there will be sort of pure play wealth managers becoming larger and larger, and focus and this conflict of interest issue will come to the front, and people will take action. So it will evolve, but globally those examples are plenty, where you start with some sort of definition of doing everything for the client, and then at some point you then sort of decide that no, my only allegiance is to the client, and wherever that product is, I will bring that.
Interesting. Just a while back, I was listening to you very intently when you talked about the 3 stages of evolution, from an RM's perspective. And, when you look at it from an outside-in perspective, you realize that probably an RM has outlived one of his cycles and he needs to move to the other. I think that was a very interesting point, and I'm sure most of the advisors who are listening into this will evaluate. But if I have to look at it from an inside-out perspective, what if I'm an RM myself and I've spent, say, 6-7 years in a company? For me, I'm too close to the mountain to see how big it is. Maybe I'm in my comfort zone. So what are the things which should trigger off for me to start thinking that maybe I need to push myself a little bit more and I need to probably move to the next level? And I'm defining the next level the way you have, for simplicity's sake, that I have to now look at moving from level 1 to level 2. I've realized that most people tend to stick to brands or to their core strengths. They do more and more of the same. They become more and more efficient, but not necessarily move to the next level. So from an RM's perspective, if I'm an RM and you see me spending 5-6 years, what do you think I should be asking myself to realize that maybe it is time for me to move to the next level?
No, so Vikaas, that I would say that, look, the comfort zone is, and it's not my saying. I mean, every sort of motivational book that you read, it's the killer of creativity and growth, right? I mean, your growth gets completely stunted if you really be in your comfort zone. If you don't step out of it, you basically don't grow, right? So I think, and it is, I mean, it's easy to say that, look, you should think otherwise, but it is a big issue in the industry, not just in India. Again, I would say globally. And I will give you an example there that, in Merrill Lynch, in the US, we had 20,000 advisors, right? That's the workforce we collectively were managing. And we would come up with, I mean, of course, our focus was that, hey, if you can make, we have 20,000 advisors. If you make everybody 20% more productive, right, our revenues will go up by 20% because they can do 20% more job, right? I mean, forget about hiring anybody or anybody leaving. Just the same set of advisors, you make them 20% productive, and their business, our business, Merrill's business, will go up by 20%, and it's a very profitable growth because you didn't have to pay people to join you and all of that. Every experiment that was done in a little sort of pockets that look, this branch, this complex, or this city, there was and there's a little bit of sort of colloquial reference there, but every time you did that, let's say if you raise the productivity by 20%, meaning the advisors 20% more effective, actually, rather than revenues going up, we used to say their golf handicap improved by 20%. Right? Again, it's a classic sort of example where, right, everywhere you make them more productive if they are in their comfort zone. So I will tell you, at Merrill Lynch, CEO at the top of the house, right, managing 20,000 advisors, it's a fantastic business. I mean, fully annuitized, $25 billion top line year after year, and growing at a steady pace. The single biggest challenge that CEO has of growth is the fact that you mentioned, that the people are in their comfort zone and complacent, right? So they try different things to really bring them out. There is a science to it. I mean, you experiment, you put different incentive structures, etc. But the challenge is real. But it doesn't bode very well from a RM's perspective, because of course that kills the growth prospects. Now, the only thing I will say is that in the US, a lot of these 20,000 advisors, they are in a small town, Nevada or Arizona, and they're earning $400,000, $500,000, and they're very happy with their life, and they don't really need to now get to the next level, so they get extra time, they go and play more golf. But in India, we are a different society, we are in a different life stage, we're all aggressive, entrepreneurial, go to, hopefully, so there is no space for complacency for anybody. So I think that question should not arise. I mean, I know it is there, so I'm saying, but it should not arise. So everybody should really fight for going for it. There's a long way to go, right? It's not, see, our business is not a demand side challenge business. Very few businesses, I mean, in fact, India, well, there are many businesses that don't have demand side. Our challenge is supply side, right? And you want to be in that business because that's what, let's say, my sort of life goal is, that can I really create better supply to address that demand? Because demand I don't have to worry about. Right? I mean, how many clients today you meet? In fact, you should do that Twitter survey as well. How many clients do you meet that say that I'm very happy with my advisor? Hardly.
Interesting.
It's a supply side problem. And you have no doubt, I have no doubt, the pace of wealth creation also in this country. Right? So if the pace of wealth creation, absolute size of the wealth per capita income is not an issue, the financialization, the real estate assets, hard assets moving to financial assets is not an issue. The clients are unhappy about their current situation. I mean, what better demand dynamics do you need? Right?
Interesting.
Only supply side. So, buck up and just aspire to really be the best version of yourself. So no place for complacency in India. In the US, and, somebody who is living in Monaco earning $1 million, I mean, he has no incentive to really go to $2 million, but we're not there.
Interesting. In the last 30 seconds, you've probably jettisoned the conventional belief that wealth management or advice is a commoditized business. Because if it is, you are probably in your comfort zone. You are not stretching it because there is a supply side constraint. I love that. Thank you so much for that answer. Sachin, over to you.
Yeah, so, Atul, continuing on that same topic. So, I agree that advisors have a very important role to play. And, as a part of our audience, we have a lot of advisors here, and I would like them to learn a lot from your experience. So, if you can, somebody who's already managing a relationship, has a good set of investors, now, is there a process is there a set of process that they need to follow? Can you articulate that for them? It's easy, life becomes easier for them.
Yeah. So, and again, this question, and maybe sort of I'm paraphrasing, but let's say this question is about, okay, what would be my advice to, the advisors, right? How should they really think about it? So, there again, I would ask a fundamental question. In fact, two questions. So I'll have two advice, right? One is, if you ask a fundamental question, which I think is a good question to ask in any business that you are in. What is the driver of your customer satisfaction? Right? You are serving a set of customers. Now, you want to really improve your service offering. Okay, how do you improve that, right? I mean, what factors are important for your customer? Now, we have done this proper survey on this topic in all markets, right? I mean, Singapore, Hong Kong, US, India, and there is only one answer on that. And that answer is that it's not investment performance. It's not also servicing, but it's actually the reach out, customer RM reach out or advisor reach out to clients. Okay. So advisor reach out meaning that, not when you have to sell a product. That sir, ye naya aaya hai, matlab, this is no. Not when the markets are doing well, but when the markets are not doing so well, right? When you do need that hand holding and call the client and say, hey, I know this volatility is there, but look, I have looked at your account. I'm completely on top of it. You don't worry, right? Or if there is a course correction to be done, you do that proactively, right? So a reach out to client is the single biggest factor driving customer satisfaction in our business across markets, right? So you cannot take that lightly, right? You can't talk to your clients only when you have to sell a product. You can't disappear when the volatility is there because you have to have a very hard conversation, and you can't bullshit also, right? So, whatever you need to say, you need to really build some depth and call your client and handhold, right? So the minute you do that, you have won the client over, right? Because then the investment performance will matter less, right? So that's one thing, right? That's one thing I want to emphasize, that look, you got to really deeply think about what drives your customer satisfaction, because that's the customer segment you're serving. And how do you do better? I mean, I can give you the second and the third important factors as well, but at least, keep in mind the number one. Second is what I tell a lot of RMs or advisors to do is to sit down peacefully and articulate their value proposition. And again, I don't mean their firm's value proposition. I mean their value proposition, right? Firm's value proposition is part of it, right? But what is your value proposition? What are you going to do for this client? And you should be able to articulate that in, just about 90-second pitch, right? In the elevator pitch. You should be able to articulate that, right? Because you're selling something now. Anybody who's selling something should be able to articulate exactly what they're selling and how is that product going to add value to client's life. And here the product is not the MLD or the alternate fund, but you. So what is your value proposition, right? And again, don't hide behind, the firm's value proposition. It's enabling, right? And serious advisors, long-term advisors do need to define their value. And by the way, you can also assume, right? If you perfected that 90-second pitch, your client acquisition will become very, very, not easier, but I mean, not easy, but easier, I would say, right? Because like I said, supply side problem, demand to hai. There are people all around you who need you, but you got to articulate that, right? Why should they hire you, right? And by the way, again, this is not something that you have to come up with on your own, right? If this thought is there in your mind, right? You talk to your peers, you talk to everybody that you know. If you don't have anybody, call me, right? And let's debate that, and I'll help you decide what your value proposition is. But crystallize that. Don't sort of try to improvise when somebody says, oh, why should I, what is different about you and why should I? Because that question will come, no? I mean, can you avoid that question? You can't. So there is one question that every client is going to ask you. You might as well So you might as well be better prepared for it. So those are the two things I would say. See, this is about being student of the business, right? Because it is a business, and that's why I say that it can't be farther from the truth that this business is commoditized, right? And so like I said, understand what drives customer satisfaction. Try to up your ante on that, whichever way you want to do. And second is, like I said, be very clear about what you bring to the client. And if you really see yourself finding a gap there, then backfill that. Right, backfill that.
Thanks, Sachin. Before you ask your next question, I'd just like to supplement one thing here. Atul, there is a book which I want everybody to read. And if you have a book which you think I see a lot of books in the background. There's one specific book which you might want to recommend. But from my side, I think there is one book which has become sort of the beacon, the North Star for me, which is a book by Simon Sinek, which is called Start With Why. Okay. I have read this book close to 5 times already. Each time I am in a state of doubt, I go through that, and it has helped me sharpen the narrative of why I exist, why my firm exists, the narrative coming across. So I think you hit upon, you actually mentioned something which is very, very important. The why of the business, getting to the core, is extremely uncomfortable. It just challenges you. The what and the how is easier, but the why is very difficult.
Yes.
So as a framework, if advisors want to use, they should, in fact, students, advisors, investors, whoever is listening to this conversation, one of the books I would highly recommend is a book called Start With Why by Simon Sinek. Sachin, over to you.
Sure, thanks. That was Atul. That was very, very insightful, I must say. Related to that thing again, like when you meet so many advisors, for your firm, you need to recruit or even otherwise, how would you, what are the 2 or 3 characteristics you are looking at an advisor, in them, that he could be a good advisor or he is a good advisor, what are those 2 or 3 characteristics that as an advisor they would need to probably evolve themselves with?
Yeah, again, something that, comes up a lot. And so if you think about, what does a super RM look like, right? So, because everybody wants to be that. So what does a super RM look like? Now, again, I would not say from the perspective of my hiring, but I'm saying, let's just say as an aspiration, right? For anybody to say, hey, I want to be a super RM and what are the elements that I need to focus on, right? So if I step back, and it's very harsh, that expectation from a super RM, right? And the way I would look at it is, again, in 3 buckets. So the first is, it's very interesting. So the first is that this guy has to be, or this girl, this person has to be very extroverted, right? Being able to walk into a room, build relationships, work the room, not get worried about phones getting slammed on their face, not worried about rejection, right? Because one of the key elements to grow is client acquisition, right? We know that. So that's number 1, right? And very few people have that, but yes, some people have that, right? So that's one. And we understand that and we accept. Second is, on top of that, you also are expected to be a financial wizard, right? Investment wizard, right? You should know why the rupee is going down and what is happening, what happened overnight in the US and what does it mean for Indian markets today, and this stock and that stock and asset classes and portfolios, etc. You're supposed to be a financial wizard as well, right? Now, there are few people that have that broad bandwidth to really understand this, because, by the way, bahut sari actual theoretical understanding of these subjects go in as well, right? Sachin, you would have done, reading books and reports and the framework and all of that, and then now you've developed your own framework, you can talk about it. But if the theoretical background, academic background, not theoretical, but academic background was not there, it's very difficult to really sort of do that, right? But now you will believe that to a super RM, this is expected, right?
Yes.
Some people have it, but by the way, most of those people are sitting behind screens. They don't like talking to people.
Right.
Now here we are coming to the second level. One is we wanted this guy to be completely extroverted, and then we want them to be fully sort of, these financial wizards. Third is when you meet your client, right? The client says, let's do this trade or that trade, and let, in my wife's account, maybe we, do this switch. And by the way, I need to get my nominations done for my son's account, and let's open, this SIP or whatever, right? I mean, they will rattle 10 instructions. Now, every single instruction, what is the mechanism? What is the fulfillment mechanism for those 10 instructions to be done? It is the RM. RM has to now take all that back to the firm and ensure that each of these get executed. And just simple execution, right? One thing gets missed: bad customer experience. So what that means is that not only I have to be a fully strategic, know-it-all, what's going on in the world, and very extrovert, but I also have to be very detailed-oriented.
Detailed, yes.
Right? I have to be extremely detailed and service-oriented. Right? Again, some people have it, but they are not. They're third set of people. They're actually sitting in operations and service organizations.
Right.
Now you combine the three, and you say that, look, here is the superhuman I want, which is not only extroverted, out there, building relationship, a very effusive personality, but I want that guy to be completely sort of financial wizard. And then the third is, I also want him to be very, very detailed. Right? And that's the difficulty, right? So that's why I'm saying supply side issue. Why is that supply side issue? Because these three skills to be together in one person is actually there, right? And then different organizations, deploy different mechanisms to pass this bucket out. But as you know, what we have promised is a single point of contact. In private banking, that's what you do. Now, single point of contact comes with this scalability challenge, because this is what you're looking for, right? So, now that's the frame. I don't evaluate every advisor. I mean, I put that frame, but I'm ready to accept the weaknesses on one or the other dimension and take the dominant dimension and see how we backfill that with other skills and resources, etc. But RMs, to be super RMs, they need to really see. I mean, this goes unquestionably. Every super RM that I have seen in any of these markets, they excel at all three qualities.
Fantastic. I think you've really given the success of the lethal weapons. You actually articulated the three lethal weapons. If they come together, how it can actually play out fantastically. Let me. Yeah, sorry, Atul, you were saying.
No, I was just going to say, and you can, with that lens, you can actually see, when you look at an advisor, you actually see that this is a servicing RM, right? Or this is a investment sort of RM who likes to sit behind the screen and talks intellect, but fails on the other two dimension. And then the third one, which has the very good first dimension, is whining and dining RM, and he kind of does all kind of sort of talk with the client, but again lacking on the other two. So that's, you will see that very commonly, and it's very important to have that lens so that you can either advise them to come up to curve on the other dimensions or find another way to sort of backfill. Sorry.
Right. So Atul, now I'll just go the other side a little bit. I had heard long back Mr. Uday Kotak. This is actually at least 15 years back. And he said that when we go into wealth management, we are going to walk the dog of the client, right? And that's what wealth management, I mean, that was how he said that that's the kind of service level that I want to go about. But, really speaking, how does one really know that my client is happy with me? What kind of signals that the client will send? And you can also give an example by way of some of the best compliments that you would have got from some of your clients. I mean, you get that so it's easy for all of us to relate to it.
See, it is, again, one of the key challenges in our business, right? As a CEO of this business, this is my hardest challenge. In a traditional setting, we are trying to solve that in a certain manner, and I can briefly speak about in what we do at Validus to address that issue. But in a traditional private client business, that's a challenge for me for a number of years. Right now, why is that a challenge? Because if the relationship between it's all about advisors, right? So let's say if I have 100 advisors, right? The experience, and we already said that, advisor is a very critical component of what finally gets delivered, because they are what I call the last mile in our business, right? I mean, and that's the last mile issue that we all face as somebody who's building the business. So they are very critical. Now, each 100 have different capabilities, right? You will accept that?
Sure.
Now, so how do I have a single high quality customer experience, right? Everybody says that, hey, you should define your customer experience and it should be this and that. And, Amazon defines it in a certain manner and controls it. And the game today is about high quality customer experience and controlling that, right? And data. So customer experience and data. I mean, every large technology business today, whether it is Google or Apple, is built on high quality customer experience delivered time and time again, and also the power of data. Now, in our business, now just think about our business for a second, right? I have no control on this customer experience, because these are not one customer experience, but 100 customer experiences, because it is dependent on the RM. And also, it is not only dependent on 100, but it actually depends on which side of the bed the advisor has woke up on that day, right? So, and I actually don't even know what customer experience is delivered, because clients don't talk to me in general, right? So if they will only, in fact, in most cases, they will talk to me in a traditional sense, right? I mean, like I said, they're trying to backfill some of that, but in a traditional sense, if there is something that is terribly wrong, that goes out of RM's control, right? He can't hold it any longer. Then he comes to his boss or whoever and says that, look, I need your help in talking to the client, because, this has gone wrong, right? That's the point you're talking to the client. Second time, if there is something to pitch, this new product has come, new approach has come, new offering has come. So I need your help. Let's talk to the client to pitch this. I need your help, because बाकी तो सब मैं कर ही लेता हूँ. इसके लिए I need your help, right? Now, both those interactions are not normal interactions, right? So what does the conclusion mean? That I have no normal, as a CEO of the business, or as head of the business or business unit or a team or whatever you call it, you really have no exposure to the normal customer experience that is being delivered, right? And then the question is, I mean, you don't even know. So how do you know? Because you're not measuring it. So how do you know it's good or bad, right? And no business can scale unless you get to a high quality, consistent customer experience, right? So it is a challenge, and it's a challenge for private wealth businesses all over the world. Now you try to get consistency with certain basic minimum rules, and the advisor needs to do X, Y, Z, and you over prescribe what they have to do. But till you do it in an offline world, you cannot hyper customize it, right? So you will have a standard template. And like I said, the minute you have anything standard, it loses its value. Because again, if you try to kind of mindlessly apply that template on RM trying to do X, Y, Z, it's gone. So here I will bring technology, because technology is potentially starts to answer this, right? So if you really now create, so if I aspire to say that, look, my customer experience is actually not just the RM, now go back to the three elements that I said, right? Servicing, the investment management or advice, core sort of financial advice, the empathy with the client, understanding the complexity, building relationship and trust, right? Now, when you apply technology, right? Because that's another question that one could ask. Every business in the world is getting disrupted with technology. Is your business not going to get disrupted with technology, right? I mean, can you believe that? No, right? I mean, the technology will disrupt it. But till you don't disaggregate these three components, you will keep believing that, RM is so critical that RM ko to aap digitize nahi kar sakte, to isliye, yes, we have no threat from technology. But the minute you disaggregate it, right, you say that, look, I need RM to bring this complexity based on empathy, based on behavioral aspect of how the client is going to behave when the market goes down or up, or the family conditions, the upbringing, attitudes, all that. I need a physical, sort of very substantial RM, right? But lot of the second and the third, which is on the investment advice as well as on servicing, can actually be digitized, right? And digital can come in and play a very significant role, right? So now when you, with that frame, when you start to overlay digital, right? I say that, look, do I need this RM to carry back these 10 instructions that the client gave? Can I really have a technology with which, before the RM leaves the room, right, not only he communicates those requests back to the back office team, but also, in fact, 30, 40%, 50% should have actually been fulfilled before he leaves the room, right? So now, again, that's a mindset. Not easy to get there, but that's, so we sort of try to, the frame we take is we are a fintech for high net worth, ultra high net worth client. And that's the way to think about the fintech element in an ultra high net worth, high net worth business, right? I mean, world over, every fintech in our business so far, thankfully, has gone in solving the customer experience for retail client, absolute retail client, right? Because the level of complexity in solving their experience is much lesser. You ask 3 questions about their risk appetite, and you deliver a mutual fund portfolio that is based on some algo or a model or a stock portfolio, and that's your advice, right? But that only works for a retail client. That doesn't work for somebody who has 50 crore or 10 crore or even 5 crore, right? It doesn't work. So you need people. But does it mean that you basically raise your hand and say that, look, you are insulated from technology onslaught? No. So these are the second and the third component. You have to go very hard and very thoughtfully to digitize and make that work collectively with the third element on top, which is your RM, right? And now, Sachin, to answer your question, I have got standardization to some extent on the 2 and 3, high quality, consistent service level, right? Fail rates are much lower, but I still have the guy who's solving for this complexity, picking and choosing what he delivers to the client, etc. But at least the base minimum experience for the client is maintained, right? And by the way, the minute you go to digital, now you have data. Because pehle data nahi tha. So I couldn't really say ki out of those 10 requests, one didn't get fulfilled or how much delay there is, whatever. But the minute you start to digitize, even the second and the third aspect, first you can't digitize, you can never digitize. But the second and the third, then you start to get relevant data. And that starts to begin to sort of say that on a consistent basis, what is my customer experience? How many clients are being sort of delivered at least the base minimum, which is at a base minimum quality level, delivered there. But the customization will, and that doesn't destroy my base experience. So the base experience is there, and then it can only get better based on the top. The other problem, by the way, it solves is that now I don't need a super RM. Like, I don't need a super RM. Now I can recalibrate my expectation of who can be a good RM because I'm backfilling some of the capabilities that previously were needed to be embedded in one body. Now you have disaggregated that. Now you don't need that body. You can have, yet deliver single point of contact to the client. Remember the challenge. See, I could have had 3 people serving the client before also, but that's broken experience, right? You can't go there. So now you have single point of experience, yet that guy doesn't have to have all 3 in his body. So again, I'm giving a lot of sort of our own thinking and secrets away on how we think about the business, and some of this is what we have sort of collectively thought about. It's not just my thoughts, but it's our collective thoughts of the team. But that's kind of the way to solve where you want to get to for solving the supply problem.
No, this is fantastic, Atul. Actually, what I say, delight. The most important thing when you are servicing is about delighting your customer, and I think you are absolutely on that part of delighting. Customer satisfaction is one part, but customer delight is a different level. And I think you're absolutely on that path. And I think best wishes. And I must admit that, this is actually our fifth probably series, Vikaas, if I remember. But I must admit that this has been one of the most insightful and very, very learning, a lot of learning for me, particularly the 2 points that you mentioned about the customer reach. That implies to my side of the business too, because when the funds underperform or when we don't do well, or say even in an event like last year COVID, it was very important to reach out to customers and so that they don't exit at the wrong time. More than us, it's about they're not exiting at the wrong time, and that I think played a very, very important role. And I think the second, which is like a absolute table stakes to my mind in terms of what is my value addition, what do I get to the table, what is my USP, and does that suit to the profile of the investor? If that actually clicks, then the longevity is for certain. As long as I have a proposition, and if that is what is matching with the investor's profile, I think then the longevity is almost there. I mean, the investor is mature enough. Somebody who has that kind of money to say that he doesn't understand is stupid of me, to my mind. So I completely understand and relate to you. And thank you so much. Really appreciate this.
Yeah, and we haven't even spoken about the complex AIF products and all the next product innovation. Like I said, our business is about good quality process, serving the client well, because the client is not well serviced today.
Absolutely. I appreciate it. Yes.
So in fact, your discussion has been so engrossing that I just realized we've crossed 77 minutes of discussion, and
I think
the
we
entire
should,
audience has been sitting through. So I'll just move to the question answer session. In the interest of time, I'm just going to make sure that we wrap up in 5 to 10 minutes. I'm going to pick up some key questions. And if you think that some of these questions have already been answered, please feel free to say so that I can leave the next question. By the way, so now you have more than one admirer apart from me on this call. Sachin just told you that. Okay,
I appreciate
so I'm just going to go across to some this thing. You talked about technology. So let me take a question on technology. There are actually 2 questions on technology coming in here. Some part of it I think you've answered. Manu Sharma asks how to gain the trust virtually. Since we have moved to a virtual mode, especially while meeting new clients or with a new firm, starting with a new set of clients in these times. Questions as an advisor, please. And the other one is similar, but not same. Is from Narendra Khadse. In today's technology advanced scenarios, is it possible to create a virtual advisory platform, self-help clients to eliminate integrity of issues of advice? Self-help platform, a virtual advisor stroke self-help platform to help clients eliminate integrity issues of advisors.
Yeah, so I think the first part of gaining trust of clients, especially a new client that you meet, is no doubt harder, of course, because sitting down with the client and having a cup of coffee, I mean, it's difficult to replace that. But what we have seen, because ours was a new firm and we had no choice but to really continue to acquire clients. See, what we have seen is exactly the kind of discussion that we had just had, right? If you really have the right content, if you have the right sort of things to talk about and approach, etc., clients are looking. See, it's not that just because nobody is meeting the need for wealth management has gone away, right? I mean, it's not. Clients need it, right? I mean, they are coming into money, they have liquidity. In fact, the investing world is quite complex. I mean, the equity everybody talks about, but fixed income, everything is sitting at 3.5% interest rate funds, and inflation is 5%. You're in a negative interest rate zone, and large part of your portfolio is there. So you can't just sit there and say, hey, let me sort of wait for things to open up and then we'll move forward. No, you always need that. So I think it is harder, but it is not impossible, right? I think there is no replacement to doing exactly what I said, which is, just sort of get up, think about what you want to talk to clients, what are your levels of sort of elements of advice, and reach out and have a call and do it exactly the way we are doing today, right? I mean, there's no challenge in what we're doing today and being able to communicate. So the message has to be right. It's harder. There's no question about that. The second part is, I mean, our personal experiences. We've acquired several large family offices, etc., purely on Zoom-based pitches, etc. the investment banking businesses, other advisory businesses also continue to do quite well, right? All the businesses are doing well. So it's harder, but not impossible. Second part is, see, the self-help. I do appreciate the point about the integrity being taken out, the integrity being a challenge, and hence I would rather sort of solve that by sort of digitizing and creating transparency for the client. See, when I said digitizing the service as well as the investment part or advice part, with digitization comes transparency as well. Lot of that will become visible to clients as well, right? So you could immediately ask that, look, you're selecting this product, why is that? And if you have digitized your investment processes well enough, then you should be on a transparent basis, all the data and information available, not in PowerPoint, but in your digital system, to be able to guide you to the process of making that decision, right? So transparency can be created, and then at the same time work on the intent of the advisor. Though I will say one thing, that the intent of the advisor is, see, no advisor is a bad guy, right, or a bad person. It's the intent of the institution that translates through the intent of the advisor, right? So advisors get blamed, but the way you set their compensation structures, the way the behavior that you really expect from them, they deliver that behavior. So it is the intent of the institution that reflects. Otherwise, we can all believe that we're inherently not sort of bad people, right? So it's important to be with a firm that has the right intent, and that problem can be solved, right? I mean, it's not about what we do at Validus, etc. I mean, I was at Merrill Lynch for a long time, right? And we didn't have advisory license versus distribution or whatever, but we had such a strong confidence, whether it's Merrill or the same business at Julius Baer, that look, you can. There is no client ever, I will challenge, ever can get up and say that, look, this product got pushed to me. Across RMs, across clients, right? Because it's the culture of the institution, right? So there are other ways to solve for that, not completely disintermediate the RM, because like I said, at assets up to a certain level, you can completely disintermediate the person which is solving for the complexity that individual portfolios may have, or financial life may have, not portfolio, but financial life. So don't disintermediate that completely, but to a large extent, yes, transparency is the answer. Provide everything back to the client. They should know exactly why we did what we did, what portfolio, what fees, all that. And that will bring the confidence of the client back.
Questions are coming through thick and fast, but I'm just going to ask you 2 more questions, okay, in the interest of time. This is sorry, Sachin, you want to say something?
No, I was saying that's a brilliant answer. Transparency is the base of integrity, right? At the end of it. So it's a brilliant one. Thanks.
In fact, I particularly like this question. It's a quirky question in a way, but it's also, I can understand where this question is coming from. It's from Mr. B.S. Reddy. He says, how important is it for an advisor to put his own money for the suggested strategy, like skin in the game? Yeah. So this is a question to you. How important is it for an advisor to put his own money in that strategy?
I mean, see, money is also a question of, how much money advisors have and personally, and their ability to put. So I don't think it's terribly important to put their own money in every strategy, but the skin in the game can be achieved in slightly differently, right? So as we define your value proposition, you can almost assume that if you were to do a due diligence on a product exactly like you were going to put your own money, right? So there is no 2 ways about that. One has to do that. Now, in the end, whether you put, a lot of these AIFs have 1 crore minimum ticket sizes, etc. So it's unfair to expect advisors to put their own money in every strategy that they talk about. But conceptually, I completely agree, right? In fact, in my, the public profile that sort of gets circulated, I have this as one of the cornerstones that I follow personally. But that's very personal to me, that I do put money in a lot of the strategies that we select, even if it is a small one. But I do. But again, that's actually unfair to expect from all advisors. But the way you analyze a product is exactly that look, you're going to put your own money, and whether you would or not.
Yeah,
interesting.
But Atul, if I can add, it also depends on the profile, right?
Yeah.
The advisor's own profile and the investor's profile could be very different.
Absolutely. Just because it's not right for you doesn't mean that it's not right for the client.
Exactly.
You're absolutely right.
In fact, just so that you know, Atul, that I make it a point to invest in each of our schemes, because for me it's very helpful. When I sit in the IC, I wear two hats. One is the hat of the CEO of the business when I talk to my fund management team, and also the second one is representing the customers in my fiduciary capacity as representing the customer and the customer myself. Yeah. So sometimes the questions which come through are more as a customer rather than as the CEO, but I think that is what enriches the entire discussion at the IC level.
Correct.
I'm going to ask you the last question here, and this is an interesting one. How do you see the role of financial planners versus financial advisors? Which is more appropriate to clients in terms of cost and honesty? I think financial planners, to my mind, if I interpret this question from Mr. Narendra Khatse, he's talking about distributors versus financial advisors. And I know that you have some very clear views on that. Yeah. So, if you would like to answer that question.
Yeah, so I think again, in my mind, these are words, right? I mean, there is no real difference between financial planner and financial advisor. They're just words, or at least I don't understand the difference very well. If, let's say, the question is about the investment advisory sort of regime or people who are under that versus distribution, there my answer will be actually there is no business called distribution. Right? I mean, the business is of advice. Ultimately, any RM or financial advisor, whatever you call them, they are in the business of delivering advice. And product is as incidental. But I really don't know if there is a thing called let me go and just distribute this product to whole host of. If that is, then that's not the business that one should classify as a financial advisory business. Now, again, the licensing regimes and how people these days, I mean, there's a lot of discussion on that, but that discussion is more around how the client pays for the services. Actually, practically, the services are not too different, but how the client pays for it, yes. In a investment advisory licensing regime, the client has the responsibility to pay for the advice that they have got, and in quote unquote sort of distribution, you get paid by the product. But I believe that what the advisor has to do actually doesn't fundamentally change, because best interest of the client needs to be protected. The context of the client needs to be applied. I mean, everything that we discussed needs to be applied.
So before I hand it over to Sankalpo, I must also tell you that there were some questions which were coming in specific products. I think Rahul Chadda is asking for some products. So for those of you who want specific advice on products, please send us a mail. And in case Atul would like his team to evaluate and respond, we're most happy to forward that to Atul, and we can take it from there. Personally, I think I speak for Sachin and myself when I say that this has been a masterclass in terms of understanding, the mind of an advisor, what an advisor should do. In fact, I can go on and on. I'll take 90 minutes just to describe what I've learned, right? But in the essence of time, I'm just going to thank you. Thank you very much, Atul, and I'm going to hand over the...
Thank you so much.
Right. Thank you so much. Thank you, Atul. So we'll come to the vote of thanks in a while. So for listeners, thank you for tuning in on a holiday. And we at PMS AIF World are committed to building a platform and of good advisors, quality advice backed by content, research, and analytics. And in the coming days, or if you've been following our work, you would have realized where we are building our capabilities, and we hope to continue doing so, demystifying characteristics like risk, return, and risk-adjusted return for clients. So before we close, we will just announce the discussions of few of the polls for just curiosity purpose. So of the audience today, 61% said I'm happy with my advisor. That's kind of the whole point. And another interesting question which I asked the audience was what kind of advisor do they prefer? Advisor who is working as a professional independently, or advisor who's associated to a big wealth outfit or a bank? So 65% surprisingly said that they would want to work with an independent advisor. So that's where the preference lies. And thank you again to all of you.
Sorry, just before you add, I completely forgot. We have to announce the winner of the question.
Right.
The winner wins a prize from Finland Academy. And Atul, I think Mr. Narendra Khadse, he asked actually two questions. One is about the virtual advisor platform self-help client to eliminate integrity of issue of advisors. To my mind, I think that was a very sort of intellectually stimulating question, which led to some very interesting answers. So if it's okay with you, should we announce Mr. Khadse as the winner?
Sure.
Yeah.
Makes sense.
So Mr. Khadse, congratulations. You win a free training module, a free training session with FinLearn Academy. And please be in touch with us, the teams of PMS AIF World and Emkay Investment Managers, and we'll send you the Moderator on that. Thank you so much.
Thank you. Thank you, Atul, for being with us. Thank you, Sachin, and thank you, Vikaas. Thank you to the audience. Stay safe. Until next time. Thank you.
Thank you. Thank you so much.